Welcome back. Money markets are now pricing in a 50% chance of a Bank of England rate cut later this morning. This follows an updated report that the UK economy showing economic activity shrank in November. Joining us from London is Jasper Lawler. He's head of research at London Capital Group. Jasper, thanks a lot for joining us. Let's first of all talk about this big meeting at Buckingham Palace today. We've just finished talking about it with our viewers here. The Queen, Prince Charles, Prince Harry, the Duchess of Sussex by phone line, apparently, all meeting to talk about how they sort this thing out. What are people saying where you are about this?
Good afternoon, Paul. I mean, one thing to say about this is I imagine this is being discussed in Canada, given Canada's importance in the whole scenario involving Prince Harry and Meghan. But if you imagine how much it's being talked about in Canada, amplify that by about 100, and that's how much it's being talked about in the UK. It's quite amazing. This is very important to the British people, the future of the monarchy. It always catches me by surprise. I think the general feeling is one of sort of understanding about the couple's situation, coupled with some sadness that there is actually a genuine prospect they might be leaving the UK, and we'll just see a lot less of them.
Jasper, let's talk interest rates and a potential rate cut. I see we led with the potential 50%. The market's pricing in a 50% likelihood of a cut. Mark Carney, a Canadian, has spoken out in the past that there are signals that it'll need to happen sooner. What are people saying over there with respect to the rate cut?
And I'm just going to interject that we incorrectly said the decision was coming today. It's not coming until January the 30th. Jasper?
Well, I think it's fair to say that the Bank of England seem to be leaning in this direction. Rob, obviously Mark Carney really spearheaded this the other day, and it was a bit of a surprise then. We know, obviously, the Bank of England have not been quick to raise interest rates over Carney's tenure. They only did once, and that was in response to cutting interest rates. So clearly there's a slight bias at the Bank of England in general. And so there's two sort of feelings that I have towards this, which one suggests this is probably coming, and that's in that other central banks have been leaning in towards the potential harmful effects of the trade war. Obviously, this week we're looking at a partial deal being signed between the US and China, but nonetheless, global growth does seem to be slowing. The UK is a very global, outward-looking economy, and it would naturally, and it already is being affected by that global slowdown. So the Bank of England trying to get in ahead of it. The only worry that I think that maybe this never does quite materialise and the slowdown doesn't quite, because we do have some UK-specific factors which are a bit separate from the rest of the world, and of course it's Brexit. The Bank of England have been generally very negative about Brexit, and you could say that they're negative about the prospects moving forward once we leave at the end of this month. Others would argue that this dispels a period of uncertainty of the economy, and that actually some investment money is going to come in, and that will make up for some of the deficit from the slowdown globally. So for me, there's two competing stories here, and it's far but certain that they actually do end up cutting interest rates anything close to 50 basis points.
Do you expect the Bank of England to speak extensively on Brexit when it releases that January 30th decision?
Well, they've not shied away from it in the past, Paul, but I think that to a large extent there's a lot less uncertainty around it now, and so there's less need for them to do so. Clearly it comes as Mark Carney finishes his tenure there, so he'll want to kind of round off what he's been trying to do at the Bank of England, and I think he probably has to frame that via Brexit. But nonetheless, there's no real need, I think, for them to make some grand predictions about how this trade deal between the UK and the EU will work out. They have their base case scenarios, and I don't think that's changed much. And so it will probably be something very similar to what we've seen in previous meetings, where they don't make a change. And I don't think at this stage, I think they're laying the groundwork through these speeches about a potential cut, but I don't think they heavily changed the guidance in the minutes after the actual meeting. I think we stay neutral for the time being, particularly because of the sensitivity around that exit date for Brexit.
Jasper, a host of data, as I understand, is being released either today and or tomorrow, specifically manufacturing, construction figures, I understand, and trade and GDP as well, I believe, are being released this week. How do you think those numbers will shake out?
We've seen a bit this morning, Rob, and the general sense is that the hard data in terms of manufacturing, from a UK standpoint, that is, I'm still answering that, is that it's just still not there. We haven't bottomed. But that like other parts of the world, it seems like a trough is being carved out. We're seeing similar things in Germany. It was less of an issue to start with in the US, but similar things there. Obviously, manufacturing specifically in contraction in the US, but other service sectors, for example, not doing so badly. But in the UK specifically, we're seeing the hard data is still bad. It's still disappointing, and that's in sync with other countries, but the soft data, the PMIs, that seems to be recovering. And if you judge on the general business sentiment out there, again, reflecting back on Brexit and the slight removal of uncertainty, because we know that we are leaving at the end of the month, I think that has room to go further, and that can help confidence in business decisions and give us a bit of a boost in the first 6 months of the year.
Let's talk about the publicly traded betting companies. That's a business that we don't really have here in this country. You have it in the UK. The shops like William Hill and other betting shops that allow people to bet on all manner of things, not just sports, but politics, royal family outcomes as well. There's no doubt bets being placed on the meeting that's taking place today at Buckingham Palace. William Hill, you say, seeing its fortunes turn around, but you also say that all of these companies are scrambling now to adjust to new rules that are incoming. Tell us more about that.
Well, Paul, yes, you talk about Canada, but actually the light at the end of the tunnel for these UK-based bookmakers is probably the US. In the UK, regulators have really been clamping down on the kinds of gambling that people can do. Something that was very popular for a while was machines where you can go into and place instant large stake bets on any number of markets. You've listed a few of them there, and it was very, very fast, very high stakes, and quite addictive, actually, it was found to be. And so regulators came and reduced the size of the stakes that you're able to put per turn, and that really crushed revenues. So they're having to look into other areas. Obviously, online expansion is a big thing, but the fact that the US have opened up sports betting in a number of states, as you mentioned, not many countries necessarily have listed bookmakers, so actually these British firms are in a state of scale in order to take advantage of that already, and there's already been some combinations with US-based companies, and so that is their future source of growth, but they need the revenue in the time being, and unfortunately for them, some bad result for the punters has meant good results for them, and they've had a bit of a boost in revenue in the lead up to that restructuring.
Jasper Lawler, thanks as always for the insight from London. Jasper is head of research at London Capital Group.